Today we got a little bit of a different video for you. We're going to be going over exactly what I look for every single morning that I trade New York Market Open. We have this video broken down into like 3 segments, right? Have it written down here. Number 1, we're going to be going over bias. Number 2, we're going to be going over news and like what pushes the market. And then number 3, we're going to be going over my entry and some examples of my entry, how we can enter off of it and how it works at the end of the video. So if you guys are curious on what that looks like, make sure to stick around to the end. And without yapping too much, let's get straight to it. So number 1 in my strategy, I do this every single morning before I even look at taking a trade, and that is determining what my bias is for the day. Yo, what's up everyone? Yo, Wes, how you doing? I do not know how to say that name. I'm sorry, bro. In any day that I decide to trade, the first step is me determining my bias. So how I do that, I work up in this top left here. I go backwards. So I start from the weekly chart. I go down to the weekly, the daily, 4 hour, 1 hour. What we're going to do, define bias. We're going to hop straight in and we're going to take a look at the weekly. And while we're looking at bias, you guys, one thing to note, before, when I was determining my weekly bias, my daily bias, and my 4 hour bias, I was only looking at the last 4 candles. And then I want to say about 3 weeks ago, 3-4 weeks ago, when I started to really backtest and figure out this new entry model, someone told me that you should do your analysis on the weekly and daily the exact same as you do on, say, the 5-minute and 1-minute. So that is what I do now. I look more into depth on higher time frames to see what it's doing. Like, say, for example, we're up here and we're trading in this fair value gap, but we're looking bearish, right? And we have a good weekly candle close above the fair value gap, right? If I were to look at the last few candles, I'd be like, damn, like we're in a downtrend. No, look at the bigger picture, right? We're in a weekly fair value gap. Anyway, okay. So first thing I look for, right? I look for the whole picture on the weekly. So we could see here, we're in an uptrend. Why are we in an uptrend? Because this is our low. We have not broken that low. And this was our most recent high after making that low. Right? We're making higher highs and higher lows. And then straight from there, we go and hop into the daily chart, which is a lot of the exact same stuff, looking at any imbalances within the market. So we got a fair value gap right here, right? We got fair value gaps down here that have also been inversed, right? There's a lot of stuff to look at on the daily. And right, if we were to just look at the last like 5 or 6 candles, we would most definitely miss this inverse, right? We're reacting off of this inverse fair value gap right now to the upside. Weekly bullish, daily bullish, boom. 4 hour now. We're going to be looking at the pretty much the exact same thing. So where is our most recent prominent high and prominent low? We have this high right here and this low right here. So yeah, we do wick below this low, but I would not consider it. I would consider this right here, these wicks sweeping below this previous low. I would consider that a liquidity sweep for now, just because we haven't gotten a candle close below this low. Price is yet to keep going in this direction, and maybe it does in the future. Like maybe it comes up, hits one of these fair value gaps or something, and then goes down. But for now, we are still bullish. For now, we are still looking for this leg up right here on the hourly. And now is where we get to a little bit more than just looking at price action. So on the hourly here, as soon as I'm done looking at price action, so we'll see what we're doing here. We have our prominent low. We have our fair value gap up here. Boom. Say we are completely done looking at our price action and what we want to do. I will open up, and sometimes I do this on the 15-minute. Sometimes I do it on the hourly, but I always do it. And you can open up multiple panels. So here I will be looking at MNQ on my left and MES, which is the S&P 500. So what I'm looking for is something called an SMT. What it is say, for example, this is MNQ right here, right? This is MNQ and this is MES. So I call these two sibling indexes. And why do I call them sibling indexes? Is because when one index does something, most often the other index is going to follow or try its best anyway, right? Just like a sibling. For example, what I mean when we're doing that, so if MNQ is in an uptrend and we're continuing in an uptrend and we make this low right here, and then MES is also in an uptrend and then is just continuing like this, and we're right here, we would mark out these lows. So we're doing a bullish example. So if we wanted to continue up, all right, I should have mentioned that in the beginning. This is a bullish example. if we want our trade to continue up, our bias is pointing us bullish, and we want to go long on something, we would also look for this now on the hourly. So we look for a bullish example of an SMT, which we're just taking the lows. So if you see here, we make a higher high, higher low, higher high, higher low, higher high, and lower low, right? And then on MES, we make a higher low, higher high, higher low, higher high, higher low, higher high, higher low, right? So this is just a higher low instead of a lower low here. Why is this important? Because number one, right, we can draw these out. Like I said before, I call these sibling indexes because they most often follow each other or try their best to do the exact same as what their sibling index is doing. So what we're looking at here is the lows within a chart. So say, for example, MES is in an uptrend and MNQ starts to break that uptrend. We will assume that MNQ will continue with the uptrend just because MES is saying that, hey, we haven't flipped bearish yet. So we're just going to assume, and it might not be the best thing. So that's why you use it with other confluences, right? But we will automatically assume that, hey, maybe this is like a little bit of a false break to the downside and we can continue upwards. Or we can maybe enter a trade if we see the right things and aim for these highs. Or maybe we aim for these highs on MES too. But we know and can assume, and you guys will get it more with market experience, right? Over time, like you'll gain the experience of seeing it happen multiple times. And then once you see it again, you're like, hey, I've seen this, right? We've taken notes on it. We know what we're looking for. We see a bearish SMT, and we look for a short. So if we actually look at a bearish example, it's the exact same thing. So same thing, looking for a bearish example, we'll just look for the highs. So high to high, high to high. Okay, now from the hourly, we will then go to the 15-minute, right? And we'll see what the 15-minute's doing. We have a 15-minute inverse right here. So it's just like spotting out all these little imbalances within the market, inverse or not. That's pretty much where it ends. So my bias stretches from weekly to daily to 4 hour to 1 hour. And on 1 hour, you're going to look for the SMT. And then if there's like a liquidity sweep, that's where I would start looking for liquidity sweeps, so to speak. And then the 15-minute, doing the same thing. We're just looking at price action. Okay, now segueing into our second part. Now from here, after I do my bias, I will do this every single time. People in stream know this. We're going to open up what's called Forex Factory. Today, I'm making this video because it is a bank holiday. We see that by the gray folder and bank holiday, obviously. But this is where I get my news, forexfactory.com, right? And if you guys don't know, I trade indices, American indices. So the only news that I'm worried about, rather, is American news. Initially, this is what it's going to look like. Like your screen's going to be absolutely littered with news, right? You don't want to watch all this shit. You don't want to see all this shit, right? The only thing we care about, if you're just like me, we care about the American news. Yellow folders don't really impact the market at all, right? So personally, I'd like to check this off. You guys can leave it on if you like. But I check it off because I really don't look at yellow folders at all. When I look for a day to trade, I'm looking for a little bit of news. Why? Because news is what pushes the markets. News and then bank capital is what's going to push the markets. Just so you know, as retail traders, I'm pretty sure we make up like 5% of the market, if not less. Like, it's a ridiculously low amount, I'm pretty sure. As far as everyone else is concerned, like banks, big capital traders, we literally do not exist in this market. Like, nothing matters. The only thing that matters to me and what I'm looking for is what kind of high impact news we have for the day. And the reason I look for that is because news fuels moves.
10, 9, 8, 7, 6, 5, 4, 3, 2, 1.
And don't get me wrong, we don't ever want to trade during news. So say, for example, I was holding a trade and there was news at 7:30 and it was 7:21. And I'm like, oh, like I'm going to stick this out I'm gonna hold through news. As much as I don't want to say it, that is gambling. Like that is seriously like banking on someone else's words for your trade to hit a take profit instead of you doing analysis, waiting for news to come out, being super patient, seeing what you need to see, and then seeing the entry model possibly if you'll use it. At the end of this video, we'll get to that. But number 3, my entry model. So in a nutshell, what is it exactly? So what I trade is consequential encroachment, or as I like to call it, CE. So what CE is a fair value gap, an inverse fair value gap, or a wick of a prominent high or low within the market. Okay, so CE, what is it exactly? CE is the 50% marker in any inverse fair value gap, order block. I don't use order blocks as often, but most definitely you can. Or wick of a low or high. And we'll go over examples of those lows or highs. But right now, we'll just talk about what CE is exactly. So CE stands for consequential encroachment. And I have it marked out on my fair value gap here. If you guys want to do the same, you can just open up your fair value gap, hit this gear here, and then go to visibility, style, and then tick on this middle line. So that is what is 50%. So take that off here. So this is the absolute bread and butter of my entry model. Like this is, if I don't see this, I am not in a trade, right? I got to see a perfect example for it for me to even enter a trade. And I think that's why I really like this entry model, because if price action is bad, it doesn't show up, right? Like if price is choppy and there's no room to make these imbalances or inverse imbalances, like it doesn't show. And then I just don't take a trade. Like it's plain and simple. Say for example, we are in a uptrend. So say we have a fair value gap here. What I'm looking for every single time that I enter a trade is for price to trade up into whatever imbalance we have and then have a close in the opposite direction. And price has to trade near, and if not near, at CE, right? So one thing I don't want to see for me to enter is we come up into this fair value gap, we get a candle close, right? We don't close below the fair value gap. We close above CE. As soon as I see that close above CE, I'm out for that trade. I don't want to enter that trade because my entry model has just been disrespected, right? So what we're exactly looking for is in this imbalance for orders to be filled and price to just take us and continue in the direction that we were heading before, right? That's the thing that I like about this entry model. There's a few things. I feel like I'm talking about it and I like everything about this entry model, but this entry model also trades with the trend, right? That's something I didn't used to do a whole lot, but we're trading with the trend big time. We come up, say for example, we make a good wick upward, and this is our candle, and we get a good candle close right here below the fair value gap. So what I would do automatically as soon as candle closes, and that's another thing too, with this entry model, you have to wait for a candle close. You can't just enter off of a candle that's still live, because like you're just going to get stopped out a lot more, because we wait until candle's closed, because if it's not, there's still a chance for it to shoot up past the fair value gap, right? We can't just try to predict what a candle is going to do. Say if we were to get a good candle close here, we'd enter a short, put our stops above the whole fair value gap, and then just target recent low, internal lows. We'll go over one more example. Say we are right here, right? Say we are in a uptrend. We make a fair value gap right here. We make a decent fair value gap right here. So what I look for is for price to trade down into the fair value gap. Maybe we wick CE here, get a good candle close above the fair value gap. We have everything else in line. Like if we have all our confluences in line, like the SMT, we're bullish on the weekly, daily, 4-hour, 1 hour, we enter, right? We enter long, enter in that John as soon as that candle closes. We're going to put our take profit high and stops below the fair value gap. It's been 3 or 4 months, been a while. Dude, that's all right, bro. It's all good.